No matter what happens on the stock markets of the world, boom or crash, one single fact will always remain. People, no matter where they are or what they do, they have to eat. So agriculture commodity markets usually, but not always, reflect genuine supply and demand, rather than sentiment about whether a particular country can pay its bills or not. Let's start at the world's biggest agribusiness market, the Chicago Board of Trade, where an average day can see more than 25 million contracts change hands. Buyers and sellers all over the world monitor what happens here and react accordingly. So what happened last week when the stock markets crashed? The most significant factor was the strengthening American dollar. I'm not exactly sure how that can happen when it's obvious the American economy is in deep trouble. Nevertheless, futures trading across the board was just about all negative for the entire week. In summary, Chicago went south in sympathy with the broader equity markets. Soybeans fell despite some massive American export sales. Wheat also slipped after Russia continued to undercut American attempts to sell into the Middle East, while corn closed on a downwards trend, but up overall for the week. Trimming the losses are expectations of a further downgrade of the American crop. To New York now for the softs, and cotton bucked the negative trend after crop downgrades in America and reports of a poor Indian monsoon. And sugar was down a fraction, with sentiment very bearish. Analysts expect that cotton price to steady around the current level, and despite cold weather in Brazil, support close to 28 cents is fairly weak. Local wheat futures faded late after strong interest earlier in the week. WA wheat for December delivery sits at $271 a tonne, while milling wheat on the east coast is at $261. To the sale yards now, and the July figures for processing would surprise very few people. National throughput was down 12% on last year. The main reason is obvious, the slowdown in exports. The slide in the dollar late last week will help, but there's a long way to catch up, and just as well, there's plenty of grass around. So there were positive tones in some categories as good cattle was scarce. The rain forecast for the coming week will again influence numbers and therefore prices. This left the Eastern Young Cattle Indicator at a healthy $3.81. That's up 10 cents for the week. And there was good reaction to last week's interview with Richard Rains from the Sanger Group. Today, Richard reveals some positive news about carcass weights and how much they've improved.
Carcass weights this year over last year are up 10 kilos per carcass. Now you can put some of that down to the seasonal conditions, I'm sure, but just out of interest, Kerry, January to May, this year as opposed to last year, we've killed 60,000 fewer cattle in Australia, but we've produced 9,000 additional tonnes of beef than what we did. The other interesting one, Kerry, is that since 1992, our average carcass weight has increased 70 kilos per carcass. Now that's a significant amount of meat over the number of cattle that are being processed, and again, that's partly seasonal conditions, but it's also got a lot to do with beef genetics, and I think organisations like the Beef CRC that have done a lot of work in beef genetics deserve a lot of credit for what they've done in increasing our beef production in this country.
Richard, we're running out of time, but a look ahead. Where's the market headed?
Kerry, this year, for the first time in 10 years, the producer has a choice. He has grass. So he's the one who can determine when he sells his cattle rather than the season determining when he sells those cattle. And he's not happy with the price at the moment, and therefore a lot of cattle are being retained on feed, which means that they're getting heavier, and hopefully one day they'll be worth more money as long as this dollar doesn't keep on chewing away at that opportunity for us. But look, I'm still, as I say, I'm still very positive on the outlook for protein. Beef is the preferred protein of choice by a lot of countries around the world, a lot of consumers, and what a wonderful position we're in at the moment to have feed. So the producer does have that option and can make that choice.
Incidentally, I did get calls asking what type of meat the Sanger Group and Richard Rains sells to Brazil. Well, I can tell you it's the rump cap, known in Brazil as picanha, and apparently they can't get enough of it. And speaking of Brazil, Rabobank's Brazilian beef analyst Guilherme Melo was in town last week and offered some observations on the industry in Brazil.
Basically, nowadays in Brazil, the per capita consumption is 35 kilograms per year. And therefore, the Brazilian domestic market accounts for 80% of the total Brazilian beef production. So roughly speaking, we can say that the domestic market in Brazil is still one of the most important markets for the Brazilian beef production.
And it's worth noting Brazil's cattle herd is massive, 175 million minimum, and the potential for exports is another worry for the Australian industry.
It's basically, we're talking about South Korea, Japan, and the United States. But of course, it will take a little bit longer to materialize because the Brazilian sanitary status is still FMD-free with vaccination, which is not allowed to export to those prime markets.
And that's the Landline check on prices.